We are back to close out another week in the markets. We got some hotter than expected inflation data this morning. We're going to be talking about that, the riveting world of yield curve inversions, all of that and more on Money Never Sleeps. All right, let's get it going today, ladies and gentlemen. Before we start into it, hit that like button, subscribe to our channel if you have not yet. Nothing that Kevin or I say is financial advice. We're not financial advisors. We're a few guys who love following the markets. Make your own decisions, do your own research for making buys and sells. Kev, we got PPI data first thing this morning. It got brushed off like it was no big deal, but I think we talked about market psychology and confirmation bias and trying to look through things through a clear lens. I know that you and I have been bearish, but this data to me, as I try to look at it objectively, seeing PPI go up more than expected month over month, year over year, kind of reaccelerating for the first time since I believe November of last year, that's not a great sign to me. It really isn't. A lot of this is due to energy, which we've been discussing a ton. We saw oil last month have its largest gain percentage-wise in over a year. It should come as no surprise that with that, producer prices are increasing. This could be the first domino to fall in the reacceleration of inflation. I think we both expect to see those numbers potentially start to pick up. The bulls out there want to tell us that, we're Chicken Little, that we think the sky is falling. But I think today is that confirmation that the Fed has not won this battle against inflation.
No, not at all. With all this data that we're getting, and again, we're looking past even the data itself, and we're seeing a lot of things that are happening in the world. Again, I think that's why you and me were willing to put our balls on the table and say, "Hey, that was the top of the market yesterday," for the TradFi, and we're starting to see that inflation is going to pick up. I genuinely believe that. I agree with Peter Schiff that core CPI is definitely bottomed, and I think that we're going to start to see a reacceleration of inflation in the United States, largely accredited to obviously oil. Energy. I mean, housing itself too. I think I saw yesterday too that the median rent in Manhattan's like above 5K now, which is absolutely
5,500.
Yeah, 5,500. Absolutely insane, right? But this is not the narrative that you're being told when you see the headline, right? So definitely, seeing PPI come in hotter than expected and then just kind of being brushed off. It's time. I think it's worth being a bit concerned right now with the direction of where we're heading these next few months with these next few prints.
Yeah, it's not great, and the markets are responding to it. We saw as soon as the numbers came out, the VIX took a little jump up. It's pulled back now. The dollar took a little jump up. It's having, it's looking like the dollar's going to close a fourth straight week in the green here. It's still not even overbought yet on the weekly. So there's still more room on the upside, to the upside for the dollar. We also had a report around consumer sentiment today. Consumer sentiment score improved. Consumers believe that we're going to continue to see inflation ease in the near and long term. To me, I'm always a believer in you should fade the public. And if consumers are starting to get comfortable and they think inflation is starting to come down and they're not as worried about it, that, I don't want to overreact once again. But from all my years of being in markets, from gambling, all these things, the best bet you can make on a regular basis is fading public opinion, because most people are wrong and they just don't have the understanding of what is going on. Not that you and I know everything, but that one sentence I saw when I was reading through it this morning was like, no, I don't agree with these people. I think they are not looking at the big picture, and that is going to reaffirm my opinion.
Absolutely. And again, we didn't talk about this yesterday, but initial jobless claims too. They came in higher than expectation too, 288K, I believe. So yeah, the public, if they're feeling the sentiment right now, they're feeling complacent. They feel like everything's, in a better position. I think that what people who have been in the markets long enough, and by that I mean institutional players, they're just notorious for fading the public, right? That might be why JP Morgan's Kelly was saying that you should keep your money in the stock market, regardless of what CPI prints we're getting. That's definitely, why don't we all just agree to follow the pack and just do what everyone tells us to do, and hopefully we make some money along the way, get some type of golden nugget just for staying in the markets. But it doesn't seem that way. And yeah, I
I
completely
don't
agree.
trust any of those fuckers at
You shouldn't
all.
trust anyone, not even us. I mean, you should genuinely come up to your own conclusions and with the data
Yeah,
that you're being provided, make the narratives and construct them to a reasonable state of, what makes sense in this market versus what's being told. Because we're being lied to nonstop. We know that's part of the game, right? If you don't know that's part of the game right now, then I'm sorry. That's gonna be a painful lessons for you to learn. But this is absolutely insane right now, and especially this close to the red zone. I think that you're gonna be lied to a lot.
yeah, people's words and intentions often diverge. So I'm not going to take, when I hear Jamie Dimon say some of these things, when I hear advisors saying like, "Oh yeah, no, stay in the markets. It's going to keep going up." I, I don't trust these
Fucking
people
liars.
at all.
Liars.
I trust, the analysis. I trust myself, and I don't even trust you, Kevin.
I don't trust you either. That goatee, I
You
don't know,
can't trust
something
a guy with
about
a
it.
goatee. That's for
Something
damn sure.
about him, man.
All right. Let's keep it moving. There's really nothing else report wise, earning wise. I still think, we've seen energy start to slow, kind of take a little bit of a breather here momentarily. Oil, crude still at 83 a barrel. It's on the run up. Like I'm looking at it 1, 2, 3, 4, 5, 7 straight weeks that we've seen an increase in the price of oil. That is after a consistent downward trend. And what we've heard out of Saudi Arabia doesn't make me think that we're going to see that change anytime soon. See a little bit of a pullback and a potential buying opportunity here in natural gas. My call the other day that DraftKings had bottomed and was oversold. That's turning out to be true. I'll up 6% today. I like that.
Love to see
Let's
that.
talk about let's talk about yield curve inversions because I know you wanted to discuss this, and this is not something that I know a ton about. I know the general premise that when the 2-year yield is higher than the 10-year, that is an indicator that a recession is coming because people, in the future, in the near term, that can't talk because people want to move their money into a shorter duration bond. But why don't you talk a little bit more about yield curve inversion, what that means, and what we can base, our coming thoughts on based on prior events?
Yeah, absolutely. I think you gave a really good definition of it. It's just, the anticipation of markets that's, the credit rating or, the trustworthiness of a nation that is issuing the bonds has gone down. So people are going to not necessarily lock up their money for such a period of time so that they start locking it up for shorter amounts of time. And then we start to see the yields for those rise as opposed to, the 10-year. So anything 2-year, 6-month, 4-month, we saw the 4-month actually hit 5.5% yesterday. Absolutely insane. It just shows you that you pretty good returns on some of the shorter term bonds. But like you said, this has been a pretty good indicator of recessions in the past. I've pulled up the 10-year, 2-year chart from TradingView. I'm pulling it up right here. And I kind of did a little bit of work on it this morning, and I just mapped out everything so that we can look at some key points within this oops, man. There you go. Let me just get rid of these to see where we have seen recessions and where we have seen dips in the yield curve where they have absolutely inverted. This goes only back to 1976, but that's okay. We don't really need to look past that. We know that there's a few more of these yield curve inversions back then, but it's like the Great Depression era. So let's take a look at this. This is on the monthly. Let's go back to 1970 or 1980, which we got the first recession on this chart. We can see that we had dipped back in August of 78. And it took about 18 months before we finally saw the recession once it had inverted, right? And it looks like the lowest point of inversion was at 1.35%. And then we got a recession that lasted about, I don't know, from January all the way to July, so roughly 7 months. And this is the time that we know that interest rates were going pretty high, right? This is the Volcker era, the Federal Reserve. I think interest rates were close to like 18% at one point. And this is just getting off of Jimmy Carter and moving into like the Reagan era. So keep an eye on that. That's when we got that first recession. Then we've had another one where the yield curve absolutely inverted once again. We got 11 months before we hit one of these. Uh, and this recession was a little bit longer. It was from July of 81 all the way to November of 82, right? So we're getting some pretty close within each other recessions. And, yield curve absolutely inverting has been pretty predictive of these two in the past. I do want to move forward to, this is the 90s. We had a little bit of a recession. This is right around George Bush when he took over, HW. Looking at this, we had a 19-month point where we dropped below the 0% and it inverted to the point where we actually saw a recession. And while this recession is fairly short, much like the one in the early 80s, this is from July 90 to March of 91, less than a year. This is still another point where once we see that inversion and it's sustained for a period of time, because if we look at this here, we got this on the monthly, we got 1, 2, 3, 4, 5, 6, 7, 8, probably like 8 months of just inversion, which means it's been sustained for a period of time. Obviously went above, but then it came right back under, which shows that, there's still that, not that trust in the longer term bonds. So then we have to go to more of the recent times. Recent times are the ones that are really important, I think, in my opinion, because we can see that there was a huge period of time in which we didn't see a recession, right? But from this to here, we started to see some of the worst recessions that we've seen, in a long time. And, the longer these go within each other, the worse it seems to get, right? So we got one here from 1990 to 2000. We got the yield curve inversion back in March or February of 2000. And it was 14 months before we started seeing, the recession hit. And obviously this goes in line with the dot-com bubble, post Y2K. And we all know that, NASDAQ and all those indices dropped considerably. A lot of these stocks that were part of the dot-com bubble dropped close to like 80% in some areas. But this is absolutely insane to see that, period of time that's passed, and then we see such a huge bubble like we did with the dot-com bubble. But again, yield curve is absolutely inverted. It's actually lower than it has been in prior to. This was around negative 0.47%. And then 2006, 2007 is kind of a weird one. And again, I'm going through all of these just because I want to show you where we are today. But we had 18 months from where it absolutely inverted. And I think there's a lot of things that happened in 2006 to 2008 when we finally did see this financial collapse. A lot of it necessarily isn't just, inflation or, the yield curve inversion. I think a lot of that was just, there's a lot of things that are playing into that with the housing market. You could arguably say that we just absolutely were buying like crazy from the dot-com bubble. Again, things were down from 80%. So things got a bit frothy there. But if we look at this, once again, it had inverted. It went above, and then it came right back under. So total amount of time that we spent under here was about, it wasn't 18 months, but it was arguably, let's see, 2, 3, 4, 5, 6, 7. It's about 11 months inverted. So again, it shows you that the time that we have inverted underneath 0% tends to be an indicator that we are going to be in a substantial recession, right? We do have a period back in 1998. This was considered a soft landing, where we didn't really necessarily see recession. And that was because the yield curve inversion was only there for roughly, a month, and it came right back up. So it wasn't even considered a sustainable, yield curve inversion. But now we have to get to where we are today, right? We didn't see a yield curve inversion back in COVID. However, we did see a recession that lasted a month. I don't necessarily consider that a recession, but if we want to be, technical about it, February 2020 to April 2020, that's considered a recession. But here we are today.
That's not considered a recession.
It technically is. Absolutely stupid.
That's not back-to-back quarters.
I know, but they also change their opinion on what it is whenever they want. So, I mean, I just went based off of a few sources that said technical recessions that we had considered a recession. It's dumb. I don't agree with it by any means. But anyways, let's look at where we are in the grand scheme of things now, right? So obviously yield curve inversions back in the 1980s were insane. It was like negative 2%. And, those were there for a while, right? But we haven't seen anything of that magnitude as of late until recent. I mean, after that until where we are
42
right now.
years. It's 42 years since the last time we had an inversion this big.
Exactly. And we're also at the levels, I believe, I don't have it on the chart, but the Great Depression in terms of how badly inverted everything is. So yeah, we're at, we hit all the way down to negative 1.06%. We're currently at negative 0.73%. However, if we stay here for a period of time, it's likely that we are going to see a recession if the past inversions have been precedent for what's to come, right? So the fact that we're this inverted right now and we're starting to see the US credit rating drop, right? So I think that we are kind of in this scenario where we could see a lot of these short-term bonds technically go up if it gets bad, right? If inflation continues to spike, because people are not going to have faith in the longer term bonds. They're not going to want to lock up any money. You can make a lot more money in the short term in different areas. So obviously they have to have some type of incentive that gets you to invest in these treasuries. Uh, right now, with CPI and PPI obviously coming in hot, we anticipate that there's probably going to be another uptick in the next print. I don't know, man. I think that we are not too far. We're 14 months inverted right now. And if we look back at all of these from when it inverted to where it was 18 months here, 18 months here. Not even 18 months. I think this was 11 months, right? It was 18, 11 months back in the 1980s, 82. It was 19 months when we hit it in 1990. It was 14 months back in the dot-com bubble. And it was 18 months back in 2006. We're at 14 months right now. So we're in that range of 11 to 18 where it tends to happen, right? Some people argue that 2006 was 16 months. Again, I that's fine by me because it obviously went above the 0% inversion level, the flat level. But 14 months being this inverted, and there's we're expecting inflation to spike up. And again, we raised rates the fastest we have in U.S. history in the past 2 years or past year. There's something that's going to give. And this is why it's good to keep an eye on these because, again, people like to say this time is different. Well, it's only different until it is, right? For the most part, I'm looking at this. This is probably a pretty good indicator that we are going to see some negative times ahead of us. I think treasury bills are probably going to go up in the short term, for some of these lower time frame ones. Obviously the 10 years, maybe even 5 years are going to go, aren't going to be as lucrative to people. And if we start to see, the dollar take off, inflation comes back, I mean, at some point, this has to give. This isn't a sustainable model for treasuries itself. Obviously, Fitch downgraded the U.S. to AA. There's
That
things.
doesn't matter, right? That doesn't
Oh,
matter.
yeah, I forgot. Yeah, it doesn't matter.
That doesn't matter. Inflation doesn't matter. We're in a vibe session, baby. Like nothing else matters but the vibes.
So yeah, I mean, obviously because we're in a vibe session, this is all bullshit. I'm gonna retract all my statements. I think I should have phrased this in a way that didn't suck and obviously paints the world in a better light than I probably see it, honestly. But yeah, looking at this right here. Plus, I think the thing that we have to keep an eye on is that there is I've seen it also that there's another potential government shutdown that's coming in October or something like that, regarding Congress getting paid. I've only seen like 2 articles on. I don't know how valid that is. Maybe it's something that they've just kicked down the road. But I also have seen that debt has increased to over 1.6 trillion in the past 10 months, which is insane for the U.S. And again, they're also accruing debt too on a lot of everything that they're borrowing too. So from how much they are getting from taxpayers to how much they're spending, plus the interest on how much they're overspending, they're accruing debt like an insane amount. So this doesn't seem like there's going to be a lot of faith in the U.S. Treasury bills long term right now. I think we're going to see a lot of those sell off, a lot of the shorter time frame ones, 2 years in the shorter. So I don't know, even close to like 2 to 1 month, that range. I think that's where we're going to start seeing a lot of those pick up. But again, that can only go so long before something does break, and I think people start moving to cash, gold, things like that.
All right. I think that is a very good analysis of the yield curve inversion. Let's talk about what everything else is going on in the markets right now.
Yeah.
40 minutes left in the trading day. NASDAQ continuing to give back a little bit here. We see crypto is just stuck in this freaking range.
Terrible.
Man. Like
It's
how
terrible.
many weeks can Bitcoin close in the low 29Ks? How many weeks can ETH close in the 1800s? It's just, and we're going to be here for we may be here for a while. We may see a dip and then range for a while. I don't think it's making any aggressive moves to the upside anytime soon. Like
No.
you got to be paid. Like I know we've talked about it a bunch, but you have to be patient. You can't get lulled into this sense of like, okay, all the sellers are gone. It's only going to be buyers coming in. So now we buy because it's going to take off and we can't be in this range forever. Well, that's not the case. We can continue to range. There are still people left holding who can sell their tokens.
Oh yeah.
That's a very real possibility. This is when you really are tested as far as your convictions, your thesis, and your patience, because it's not easy to just sit around, especially if you have cash on the sidelines, like just waiting. It's like, trust me, I would love to see a good buying opportunity and to put my money, that I have on the sidelines back into the market and just not have to worry about it anymore. But I'm just not willing to do it yet.
No, I mean it's we're not seeing anyone buy, right? I think we saw a lot of open interest with Bitcoin on the exchanges because a lot of people were anticipating this Bitcoin ETF to go through. It got delayed once again. I'm going to tell you something right now about this Bitcoin ETF. The reason it did not go through is because there's too many big players in the space that are taking up market share from what BlackRock, Fidelity, all these other companies, ARK, that are going to have these Bitcoin ETFs. There's just too many of them in play right now. And by too many, I'm talking about Binance. It just is what it is, right? They're not going to want people like that making money. They're going to want their own institutional people that are making money. It's part of the game. Whether you like Binance or not, I really don't care. I think everyone's an asshole in this situation, but that's part of the reason why we're not going to see it until they go under. And the other thing is Bitcoin's at too high of a level right now. Why would they be buying for, why I don't understand when it's been overbought for so long and then they get the ETF approved and then they start like loading up to the point where obviously they're being profitable because people are buying into this ETF BS. It's like, no, they're getting people hyped up so that they can dump the market on them and then they can buy it up, scoop everything up when it's at 10K or, sub 15K. That's the way that they're going to make money. They're not going to make money buying the top and then expecting more money to, flow in. I don't think we're seeing any money flow in until we see an absolute market capitulation. And I don't believe we've seen market capitulation yet. You can say FTX was capitulation by all means, but I don't think that's in the grand scheme of this entire macroeconomic global economic outlook that we have seen true capitulation to the point where it's like, okay, that marks the bottom. That marks everyone who was unable to be shaken at first. They're completely shaken out of their positions, and now we could start acquiring assets because we've loaded up enough cash on the sides to be profitable, and money will eventually flow into the markets because pretty much all the dark days ahead in the market are behind us. We haven't seen that capitulation yet, but that's why the BTC ETF has not been approved. It's going to be approved in March, most likely. And if that's the case, that means we're probably going to see that crash sometime between now and then. My
But the
honest opinion,
halving,
fuck the halving, fuck the moon, fuck all that shit. All right. I'm sorry. I can't stand the moon boys anymore because I've seen so much bad information just being spread there. And here's the thing. Yes, Bitcoin has not ever seen anything like this before, right? It's gone through bear markets, but it has not been through a recession, a true recession, and has not been through something to the likes of 2008, 2000, right? This is absolutely just people hoping that what's worked in the past works this time. And again, I said the same thing with the yield curve version. It's the past always repeats until it doesn't, and that goes just the same for Bitcoin halving, right? I just don't see in a place where people are saying that the whales are accumulating. They are not accumulating at all. You would know if they're accumulating because the price would be going up, and BlackRock would be pretty much just having a massive wallet that's increasing. It's
and
not
the
right now.
volumes would be more than
Volumes are dead.
flatlined. I mean, volumes
I,
are so dead.
I read an article today. I was talking from I think it was like Forbes. It was talking about Binance and how much their volumes have dropped. To again, they're completely quiet. They don't say anything about how much they have. They're estimating that it's $5 billion in revenue that they're making every month now because the volumes have dropped so significantly. And it kind of makes sense too. With BNB and all their tokens, they're creating these launch pools so people could put their coins on the exchange and lock them up, but the price can't fluctuate because no one can sell their tokens. Absolutely like wild. And that's where we are right now. We're at a point where, the price is being held up artificially by a lot of things, but at the same time, it's like, why if we're in a bull market truly, why are the volumes not up and why is the revenue so low for a lot of these exchanges? It's not just Binance. All these exchanges are absolutely bleeding right now. I think Coinbase is one that's we're going to continue to see that's going to have negative revenue. I don't know, going into the end of this year. Just no one's buying this shit. And if you're not seeing enough trading volume, they're not making any money. So that's just one thing to keep in mind. I don't necessarily see Bitcoin going significantly up right now because there's just such low volume to the point where it's like, okay, the amount of money that can be made to the downside is greater than what's there to the upside because of how low the volumes are.
All right, let's wrap it up for the week with just looking at a couple charts. I want to keep it simple here.
For sure.
Let's go and let's look at the weekly since it is the close of TradFi. Let's just look quickly at the weekly for the S&P, the Nasdaq, and the Dow. I see.
Definitely.
Let's go S&P first. I see that is starting to move into, it's overbought. It's starting to move down. We're gonna have back-to-back losing weeks on the S&P. That hasn't happened since May. It's been up only. We were due. There was some regression that was inevitable. We had back-to-back losing weeks there. And they weren't even they weren't that big. Where it's kind of time that this market cools off a bit. Next week, there's also and this is why I want to talk technicals for next week, and for the close of this week is there's no data next week that's honestly going to move the markets very much. Like if we look
Right.
at the calendar ahead, I don't really think there's much until Friday the 25th when we get the next PCE reading. So I think right now it's just a matter of market's going to move based on news and based on technicals. And we can't really predict, there's nothing predictive in the week ahead for news from a data release standpoint.
Absolutely. Any news that does come out is going to be, on the spot, and that's definitely going to influence the markets if it does. But this seems like we're in kind of a ranging market, right? I think that August, for the most part, is going to be boring, but I think August is going to be vital for a lot of people, especially bears, because if you can survive August, I think we're going to start seeing the market pick up again in September, towards the end of Q3, and then into Q4 with October. So looking at the S&P right here, we obviously got rejected off this trend line, right? This is why I felt confident saying that the top has been put in for the major indices, whatever it is. This is, I know, man, it sounds wrong. Maybe it doesn't, but it does. Yeah, I got rejected here, and obviously we're coming down. And this weekly close, I would like to see, obviously, I mean, yes, last week was way bigger of a move, and I think it's because we got that harsh rejection off this line. This week, obviously, we're down roughly, what is that, 0.17%. It's not a huge move, but at the same time, we can obviously see that the stochastic RSI is pointing us to the downside, and this 50 moving average is coming up. So I think that we are going to end up, maybe not this next week, maybe in a few weeks because we have some time. I think that this is going to creep up enough to where we're going to see if we can find some support on it, and if we can hold that support, then maybe we test this red line once again, right? This trend line right here. But if we are able to hit this and it fails to go through, then obviously we're going to start seeing that we're in a bit of the possibility of being in more of a bearish move to the downside is going to be more evidence, and that would be with a retest of the 200 EMA. But for right now, I think that this week, we could honestly even just kind of trade sideways for a little bit and then have this 50 come up and then just test that one time, and maybe we hold it, maybe we don't. It's going to be a true test for this one. I think that we are finding really good rejection up here. And again, if we're not putting in higher highs, then likely we're trending to the downside. And that's where I honestly see us going right now. I think, again, we've talked about this before, where we are. It's an A, B, C correction. Will it go here? I have no idea. Maybe it goes a little bit lower. As a diagonal pattern, it's very possible. But again, this is where I think we are. I think we're on the trajectory to the downside. We just have to see if we start seeing some of these tests of the 50 as we come down, as we find resistance on this line here. Let's go to the Nasdaq. Nasdaq's been a little bit more fun, right?
Yeah, definitely more volatility there, more movement to the downside. We're starting to see the shine wear off on some of these AI driven stocks.
Nvidia.
Really, really rough week Nvidia is just getting clobbered.
Yeah.
And this is, they're 12 days out from earnings. I'm looking at Nvidia on the weekly right now. It is looking like nice little almost 9% drop this week on Nvidia.
Yeah,
It's been
insane.
it's a bad month so far. We'll have to see where earnings come out, but we discussed that they're about 12% on the month or over the last 2 weeks. So we're looking at continue that hype, man. It was just all you had to do was say AI, and it went through the roof. Nvidia showed a few demos of some AI in a game, and everything went nuts. It's going to come back down to earth. You have to be patient. That's why I was comfortable selling some of my position, even though it kept going up. I was like, no, I'll just wait.
Yeah.
I'll wait. I'll buy some of this back at at 300, at 250. Like it's fine. I'm not going to stress about it. I think it's going to do great long term. This is just overcooked at the moment.
Oh, absolutely. And I think that Nvidia is still extremely dangerous because that was the big earner on the year, and it's very close to losing the $1 trillion market cap already. If I'm not sure if it has or not yet. I don't
It's
know what the
still at
level.
1.013.
Yeah. So, I mean, it's close, and I do anticipate it to go down. But again, if Nvidia goes down, what's going to go down with it? NASDAQ, right? And there's a lot of other stocks that have gone down. The Magnificent Seven, some call it, I call them the seven stocks of the apocalypse. They have definitely taken a bit of a push to the downside. We can see that Netflix is at 422 right now. Apple's at 178. Very
I
different
wish
from
there
where
was
they
a
were 2
chart.
weeks ago, right?
I wish there was a chart in trading you for the Magnificent Seven. That would be a nice
We
one to look at.
we could create it.
We could.
I'll see if what we can do. But
Okay.
this is very similar to the S&P, right? We got rejected here, we got rejected here, and we're making a pretty good move to the downside. If this continues, these weekly closes, to the downside, it gets harder to believe that we're going to come up and test, this level again, right? I think main reason why that would be is because you would need a lot of liquidity to come into the space. But if a lot of it drains out based on fears of, I don't know, inflation rising, or just AI isn't what everyone thought it was 3 months ago, then there's just not going to be that excitement. I think a lot of people that were excited about this stuff are already in the market. I think a lot of people who are smart about getting out of the market have taken profit, and that's what we're seeing here. Again, you need pretty much perfect earnings in order to keep pushing up here. Amazon was probably the only one that did a pretty good job at that, and again, that might even be more of a defensive stock, if anything. But looking at this, I think that is very similar to the S&P. We're going to test this 50 moving average at some point. I don't know if this is going to climb while we kind of stay stagnant. I really don't know what the direction is. August could honestly be a little bit down, a little bit sideways. And I think that would be the most reasonable thing, especially if we don't have major news, if we don't have data coming out, right? So we'll just keep an eye on that. I think that's, I don't know if I would necessarily believe that we're going to retest this red line up here. If we put in another week to the downside, I think that we're going to start seeing a bit of exhaustion on the buys up. Again, we've seen every buy, every time it's been bought up, like I think CPI data yesterday, it got rejected right after, right? It was just a major sell off. So I think people are definitely selling off these rallies and taking profit at this point. Now, the Dow is very different. Dow is one that's going to be a little bit more resilient, in my opinion. I think you also agree with that too, right? It's going to be more of the defensive position for a lot of people who are in the market. And we can kind of see that it's in this range right here where, yeah, it absolutely got sold off. We got a bearish engulfing candle, but then people are buying it back a little bit. So I think this one's going to be a bit of a longer term fight to get to that point where we've seen the Nasdaq and the S&P definitely take a bigger turn to the downside. This one might be a bit of a battle, but again, if we look at the technicals where we are on the weekly and stuff like that, we're completely overbought on the weekly. We got resistance here, and we're in this parallel channel, and these parallel channels tend to break to the downside. This one broke to the downside. That's right here. Came down all the way to 31,380. And then here, I anticipate us to come down. I think we're going to break through the 50 moving average when we do break down, and we're probably going to test the 200. Again, this is macro. This is macro. We're keeping an eye on it. Obviously, things aren't going to move fast unless things in the space are absolutely moving fast. I would anticipate that would be some type of financial collapse or scare that would bring it down that fast to these levels. But again, anything can happen in the next 2 months, next 4 months, honestly. But yeah, I think that we're going to see this one maybe trade along this trend line for a bit. And maybe that's when it breaks at some point. Let's see if I can just move this up here. We could even, we'll just extend this all the way just to see where it could potentially break if it does decide to trade sideways along this range for a period. It'd probably break somewhere around this level right here. Or, I mean, it could honestly break even before that, but I think this would be the extent of it, November of 2023. But yeah, I think that we're going to just trade sideways, maybe come down a little bit. And I think that we are going to break from this channel and go down. I just think this one's going to be a little bit harder to break because, again, I think a lot of the hype was more so in the S&P and the NASDAQ due to all the AI stuff. And that was kind of underperformed while those were kicking ass. The last thing I do want to check one last thing because we did throw it in the thumbnail is the QQQ.
Yep.
So this is one that I have no interest in the QQQ at all, but I just wanted to take a look at the chart because I think a lot of people are thinking of shorting it. And again, it's very frothy right now, right? It's look how much of a recovery it's made from the lows down here at 254 back in October of 2022. I think that we put in the top already. That's just my opinion. But I do think that there is on the smaller time frames a bit of a push to the upside before we start to take out maybe some of these lower areas. So if we can see at the top right here, price is coming down. We're finding the 50 moving average on the daily. I think we could find a bounce to maybe this zone right here. There's a bit of a gap that needs to be filled. Maybe we go up to it and we just get a little wick, and then it just is a wick down, and we start to climb back down again. This is just in the smaller time frames because everything can't go down, in one full swoop. This I do think is going to get tapped. But that might be a bit optimistic. But if no news comes out, it makes sense that there would be a potential opportunity to tap that and then continue going down before the rest of the year, end of Q3 into Q4. But there's a lot of gaps down here, guys. There's one here. Ooh, I just ruined that one. There's one here, and I believe, is there another one down further? No, there isn't. So these are the three main gaps I think that are going to be filled on the daily. Now, here's the weird thing. This is, to me, just looks like a corrective pattern, maybe a flat correction. Could go with a little bit of an overextension in that C wave, but I think wave A is done. I think wave B is done. Now we're just waiting to see this come down, right? But let's go to 2008. Again, I hate to say go into 2008 always, but this is going to be just to show you in perspective how these markets can move. And when they do move, it's pretty nasty. So I'm going to take the height from back here in November 2007, which is technically when the recession started. And we're going to go down to where it bottomed. And that bottomed right around here in November 2008. It's down 54%, right? So yeah, 54% is how much it dropped in 2008 with that recession. The reason I do that is because I have a lot of these red lines up here, right? A lot of these red lines. And these are all levels of support that I think are potential targets. But if I say it's going to drop 54% from where it currently is to down here, you wouldn't believe it. I think that we have to go up to this top. And, 54% puts us at, right between the 187, this line here, and down by 165. And if we really wanted to be super bearish and say it goes to 62%, that puts us at 144. These are all strong levels of support, as we can see back here. The the bear market 2018, March 2020. Obviously, our levels of resistance are now going to be levels of support because, we bounced off those in the past. But yeah, this is a very big possibility. I mean, it's very possible that we go to some of these levels down here, right? I'll put it right between here at 175 between these two major ones. So it's lined up with 2008, 54% retracement. Again, we don't know what's coming. We don't know how vague it is, this recession that is coming. I genuinely believe that there is a recession. Obviously, we talked about the yield curves today, but a lot of these stocks are just, I mean, it's very possible for them to just absolutely bleed, their market caps and the price to go down that low. And I think if we do get to a point where we start seeing margin calls, we start seeing limit orders be filled on the way down, we start seeing, this spiral of people who are just selling because, okay, everyone else is selling, let's panic. It's very possible to get here very fast. And that's the dangerous part of this market. But again, if you're prepared for it, then, maybe there's an opportunity to short this QQQ, right? Let's see how it is in August. I don't necessarily see the volumes coming in for a lot of things. So if, we get to this little spot right up here, maybe it's not a bad idea. The main thing you want to keep an eye on is your liquidation level. So if you have a extremely, close to the top liquidation level, might not be necessarily the best thing because they might just chase you out of your position and then go down anyways. I would definitely be low leverage in something like that. If I were to absolutely like short this market, I think that's 2 to 3x is probably my risk tolerance. I wouldn't go anything above that. That's how I'm in my positions now. But I think that's, being so close to the top. Let's see if it does shoot up to this level here. And I think that if we do find some resistance at this 379 to 380 level, there's a good chance that, okay, we're going to continue moving down. It might be wave 3 of this move, and that probably could be a potential really good short. I'm not going to tell you to short it, but it might be a good entry level if we see a rejection at those levels.
It wouldn't be the big short, but it would be the really good short. Okay, we're going to wrap it up for the week on that note. Appreciate everybody for watching. Once again, hit those buttons down below. Like, subscribe, comment, share us out on social. All that stuff helps a ton. We'll be back Monday to kick off another fun week in the markets. Appreciate everybody. Mr. House, you are the best, my guy. Have an awesome weekend, everyone. Have some fun out there. Get away from the charts for a little bit. I'm talking to you, Kevin, and we will see you next week.
Take care, everyone.